So in chapter 14, we're going to talk about uncollectible accounts. So what an uncollectible account is a sell on account that the people never pay on. So we have this accounts receivable where we will have certain customers that we allow to purchase stuff from us and pay at a later date. It is an asset. Sometimes people don't pay. That's just kind of the way it works. Sometimes you give somebody that trust and they don't ever pay their account. And businesses have to have a way of recording that in their books to show that those accounts were never collected. Sometimes these are referred to as bad debts, meaning that they're bad. Nobody's ever going to pay them. One of the methods, the allowance method of recording the uncollectible accounts, is basically where you estimate the value of what you think is of your sales for a year or a fiscal period are going to be uncollectible. And then you record those in a contra account. If you remember, a contra account is an account that contradicts the rule. So when we use accounts receivable, it is an asset. Accounts receivable goes up with a debit and down with a credit. Then we have uncollectible accounts expense, which is also an expense. Our contra account that we're going to work with is this allowance for uncollectible accounts. It contradicts the rule of accounts receivable. Accounts receivable goes up with a debit, down with a credit. Allowance for uncollectible accounts goes up with a credit and down with a debit because eventually it's going to decrease our accounts receivable, much like our drawing decreases capital eventually. So some vocab here. Book value. Book value is the difference between the asset account balance and the related contra account. So if you have a $500,000 balance in accounts receivable and you have a $100,000 balance in allowance for uncollectible accounts, you subtract those, your book value would be $400,000. And then the difference between the balance of accounts receivable and the allowance of uncollectible accounts, we refer to that as book value of accounts receivable, which is what we're dealing with in this chapter. There's book value of other things, but this is going to be accounts receivable. Net realizable value is the amount that you expect to actually collect. So if you have $500,000 in your accounts receivable and you expect to be able to collect $400,000 of it, that would be your net realizable value. So a contra account is usually assigned the next number in the accounting number sequence. So when we talk about accounting numbering your accounts, and we know that we number our accounts by tens, and that if you stick one in the middle of two accounts, it goes by the 5, so that we have room to add accounts in there. So if accounts receivable is 1130, then its contra account, allowance for uncollectible accounts, is going to be the 1135. That still leaves you room in there if you needed to add something in between. So there are basically two methods that we can use to estimate our uncollectible accounts, because you don't know for sure when you make an agreement with another company or with a customer on selling them stuff on account, you don't know for sure that they're going to pay that debt. And so there's no real way of knowing exactly at the beginning of a fiscal period, exactly how much of that is going to be uncollectible at the end. And so we have to estimate it. Basically, we have to take an educated guess. So there are basically two methods. The first one is called percent of sales method. And that's basically just where you can look back at history of your business and how much you've had in sales, and you have an estimate of what you think your sales account is going to be, and then you estimate a percent of that is going to be uncollectible. Typically, that is done by looking at, like I said, past fiscal periods and how much was uncollectible. So in this example here, if we had $700,000 in sales, and I don't know why this is there. Let me fix that for us real quick. Sorry, typo fix there. So if we had $700,000 in sales and we estimate that 0.5% of those are going to be uncollectible, you just do the math and you would use $3,500 as your uncollectible accounts estimate. The second method is called percents of accounts receivable method. And so the first one was the percent of sales. You predicted your sales. This is percent of accounts receivable. So the percent of accounts receivable method uses an analysis of the accounts receivable account to estimate how much you think is going to be uncollectible. Percents are typically, again, based on past experience, like I said. So if a business has a 1% rate of uncollectible accounts in one fiscal period, they can probably estimate that they're going to have about that same percentage in future accounts receivables. There are things that could make this change. So, like COVID, nobody knew a year ago that we were going to have this pandemic and that our businesses were going to be shut down for 3 months, and then the hours were going to be regulated, and the number of people that can be in your store and your business and that kind of stuff. And so that's something that was completely out of the blue that we couldn't plan for, but you have to react to it. And so that could be something that might change the percentage that you use. So if typically 1% of your accounts receivable are uncollectible, this year it might be more like 5%. Who knows? Because of the whole thing that has happened with COVID. And there's other things. Any type of economic turndown could cause it. Also, an economic upturn could lower your percentage. So there's lots of things that could change that. But it's a good guess to just go with the percentage that you've had in the past. However, it's really important that you don't change, a business doesn't change the percentage that they use to try to alter the way their financial statements look, to maybe show that their net income is less than it was, to avoid paying taxes on money that they've had and income that they've had come in. So the GAAP rule, the generally accepted accounting principle rule of neutrality, basically states that you are going to try to be as honest as you can with those estimates. So in the book, in chapter 14, 3 Green is the company we're using, and they use the percent of accounts receivable method. And that's what we're going to go through with using. And to start out with, to be able to use this method, you have to do what they call aging of accounts. And basically what they do is most businesses will lump their accounts receivable accounts into 30-day increments. So a lot of times, if you use, say, a 210 net 30, 2% discount if you pay within 10 days, otherwise the net or the full amount is due in 30 days. So they usually go in 30-day increments. So 30, 60, 90, 120, it just, that tends to be how businesses use it. And they indicate, if it's current, it's in the 30-day period. If it's past 31 days, then it's late or past due, and that's how they do it. So there are percentages that they can go from. Again, you go from your history of other ones. So in this example, this shows that if the account is current, usually about 1% of those accounts that are current right now are going to be uncollectible. If those accounts go to 30 days past due, 4% of them. If they go up to 31 to 60 days past due, we're showing that about 12% of them are uncollectible, and that percentage goes up. And that just makes sense, because if somebody hasn't paid their bill, the longer that bill is out there, the less likely you are to collect that money, because there's a reason they're not paying that bill. Maybe they've gone out of business. Maybe business is not good. Maybe they've lost their job. Lots of reasons why they're not paying. And the longer they go without paying, the more likely they're not going to pay, period. So the first thing that a business does is they have to age the accounts receivable. And so they basically go in with all of their accounts receivable accounts, and they put them in how long they're past due and if they're current and all of that kind of stuff. Then you come in and you total them up. So in this example, they have $11,774.01 that are current. And we estimate that 1% of that current is going to be uncollectible. So you come down and do this and you do the math. Then we have $5,557.05 that are 30 days past due. we predict that 44% of those will be uncollectible, and so forth. 30 to 60 days, 12%. And you just do the math and you add up your estimate, and that gives you the estimate of what you think your accounts receivable are going to be uncollectible at this time. Now, if you have a balance in the allowance for uncollectible accounts, you're going to subtract that out, because we're predicting that $2,509.25 of our total accounts receivable for this cycle are going to be uncollectible, which goes into our allowance for uncollectible accounts. Well, we already have $125.15 balance in that account, so subtract those two out, and the difference is what you're going to have to do for your transaction that we're going to do to put this into that account. So that amount is how you do that. And again, as I've said many times, if you were using something like QuickBooks or any kind of online accounting, you would have this set up in the program and it would do those estimates for you. But it's important for you to understand how it works, so that when you set that computer system up, you know how to put those percentages in and make it right. So we do an adjusting entry at the end of the fiscal period to put that estimate of what we think is going to be uncollectible into that allowance for uncollectible accounts. So when the allowance account has a previous credit, like I just said, the amount of the adjusting entry is the difference of the two. So we're going to have accounts receivable and uncollectible accounts expense, because that is an expense of the business. So we have $20,381.81 in accounts receivable. We are going to then do an adjusting entry. We're going to debit allowance for uncollectible accounts, or credit, I'm sorry, we're going to credit allowance for uncollectible accounts, because if you remember, that's our contra account. Accounts receivable has a debit balance. To decrease that, we have to credit it. So that's our adjustment there in that contra account. And then we debit the expense account, the uncollectible accounts expense. And that goes in your general journal when you record your adjusting entries. And again, just like all adjusting entries, you start with the word adjusting entries centered on the first line. And we do that because we don't have a source document. Most of the time, this is going to come, if you remember, we do a worksheet and then we do all of these estimates and stuff. And so we don't technically have like a check or a receipt or something like that. So we're just going to center the words adjusting entries. Then you start with your date, your debit, and then your credit. And what that is going to do is it's going to take that amount that we did back here on our little chart right here. It's going to take that amount and add it into our allowance for uncollectible accounts, so that that account comes up to date for what our estimate was, which was $25,009.25. So there are really 4 questions that are asked when you're analyzing the adjustments for this uncollectible accounts. The first one is, what is the balance of that uncollectible account, allowance for uncollectible accounts? So you got to know what that balance is in there, $125.15. What should the balance be? $25.09. So to figure that out, you're going to take the difference. You're going to take the $25.09 minus what's already in there, and that's where you get that amount for the adjusting entry. Then the new balance of the allowance account subtracted from the accounts receivable is what we call that book value of accounts receivable that I talked about a few slides back. So in this example, our balance in accounts receivable minus the balance of the allowance account shows us that our book, what we call our book value of accounts receivable, is $17,872.56. That's what we expect to collect out of the accounts receivables that are currently outstanding and not paid to us. And we expect this amount to be a bad debt.